Welcome to WCS Money Tutorials. This video will show you how you can earn a fabulous return with your premium tax credit that is used to pay for the health insurance under the Affordable Care Act. This video will also show how you could qualify for the credit if your income is too high, and it also demonstrates two government calculators that you can use to estimate your premium tax credit and how much you can increase it with a few tricks. This technique that I am going to show will work for any tax year as long as the Affordable Care Act, what many people know as Obamacare, is law. Everyone can earn a nice return by increasing their credit, but people whose income exceeds the income limit to qualify for the credit may qualify for the credit using this technique and can also earn a much larger return on their investment. To qualify for the premium tax credit, you must get health insurance coverage through a government exchange, such as the healthcare marketplace run by the federal government, or the marketplaces run by state governments. You cannot be eligible for health insurance from an employer or from the government. If you are married, then you must file jointly. You cannot be claimed as a dependent. Your household income cannot exceed 400% of the federal poverty level for your household. But if it does, this video will show how you may still qualify for the credit and earn a great return on your investment. A great feature of the premium tax credit is that it is fully refundable, meaning that if the credit exceeds your tax liability, then you will receive the difference as a refund. However, many people, especially self-employed people, whose income exceeded the maximum for the credit, complained about the high cost of health insurance, but I will show you how you may be able to qualify even if your income is too high. Indeed, depending on your tax situation, this return may be so fabulous it would absolutely be a sin not to take advantage of it. There are reasons other than income that may disqualify you or a member of your family from claiming the premium tax credit. Anyone eligible for health insurance from an employer or from the government, or who can be claimed as a dependent by another taxpayer, do not qualify. The members of your household that do qualify are referred to as your coverage family. The members of your household whose AGI must be counted is referred to as your tax family. If any member of your household has income less than the threshold required for filing a tax return, then their income is not included as part of your household income. This is an example of how these concepts are applied. You and your spouse have two children who earn $5,000 annually from part-time jobs, but they are covered by a government program providing health insurance for children. You earn $20,000, but you are not eligible for coverage from an employer or from the government. Your spouse is eligible for employer-sponsored health insurance and earns $30,000. Therefore, your coverage family consists only of you because only you are not eligible for receiving health insurance, providing minimum essential coverage. However, your household income will equal the $20,000 you earn plus the $30,000 your spouse earns for a total of $50,000. Since income earned by your children is less than the income required for filing a tax return, their income is not counted, so your household income that determines your credit is $50,000. The amount of the credit depends on how much your household income exceeds the federal poverty line. This is for the 2021 tax year. The first column is the family size, and the second column is the federal poverty level for that family. The third column shows the maximum income that qualifies for the credit, equal to 400% of the federal poverty line. However, if your income happens to exceed the maximum, then I will show you how you may qualify for the credit and earn an enormous return on your investment while doing so. How much your income can exceed the limit and still qualify for the credit depends on your particular tax situation. The main factors include age, geographic location, the size of your household, and whether you are self-employed. This is a summary of the factors determining the premium tax credit. Note, however, that the credit will not exceed the annual premium for your insurance. However, considering the cost of insurance nowadays, this is still a lot of money. The most important factor determining the premium tax credit is your AGI. Adjusted gross income is simply calculated by subtracting adjustments to income from gross income. However, your AGI is modified to account for income excluded from your regular AGI. Some non-taxable income is added back because this credit was created for taxpayers unable to afford health insurance. People with a lot of non-taxable income are presumed to be able to afford health insurance. Whether you qualify for the credit and how much you qualify for depends on your household magi. which is the MAGI of you, your spouse, and any dependents who are required to file a tax return. For most people, MAGI equals AGI, and most of the examples in this book assume that. But if you do have significant amounts of non-taxable or excluded foreign income, you can still benefit from this information, but you will need to account for these other forms of income to determine how much you need to lower your AGI to increase your credit. However, both your AGI and your MAGI can be decreased by increasing your adjustments to income. Adjustments to income are listed in Part 2 in Form 1040, Schedule 1. The most common adjustments to income include contributions to tax-deferred retirement accounts, contributions to health savings accounts, student loan interest, paid alimony, and self-employment expenses. Although there are many adjustments to income, the best way to lower your AGI, and over which you have the most control, is to make contributions to tax-deferred retirement accounts. This screen shows the current limits for IRAs and 401ks and related plans, but contributions to other tax-deferred accounts will also work. You can see how this is calculated on Form 1040. The first 9 lines report various forms of income, such as wages or investment income. Line 10 is adjustments to income, which is the total from page 2 of Schedule 1 shown previously, which is subtracted to yield adjusted gross income. If you need additional information, you can review Form 8962, which is used to calculate the credit, and the instructions. Although most of you will file electronically, this form does show how the credit is calculated. This is an enlargement of Part 1, showing in detail how the credit is calculated. This is the worksheet in the instructions for Form 8962 used to calculate modified adjusted gross income. As you can see here, Worksheet 1.2 shows how to calculate household income, since the credit also depends on your dependents' combined modified AGI. They can also reduce their AGI by increasing their adjustments to income, which will help to increase your household's credit. More information can be found in Publication 974. Links are also provided in the description. A quick way to get estimates of your premium tax credit is by going to healthcare.gov. Note that the top here is all ads. Make sure you click on the official website. To start, enter your zip code. Then click your geographic location and continue. You can see there are 3 steps, and we just completed the first step. So now we're going to input information about you and your household. Click Start. If you don't have a plan ID, just skip it. Now enter your household information. Then click Continue. Enter your age, sex, and anything in this section that applies to you. Then click Continue. Here you see a summary of the information you input. You can also add a spouse or dependent here. When everything is done, click Confirm. Enter your estimated income, click Continue. This shows you your premium tax credit for the month based on the income and other information that you have provided. You can now view the plans if you want, but we just want to use this estimator to see how much you can increase your premium tax credit. So click View Steps. Edit your household income. If you contributed $20,000 to your 401k plan, then you can reduce your AGI from $50,000 to $30,000. So we put that here and then click Continue. Now your credit increased to $350 per month, a substantial increase. As you can see here, by increasing your premium tax credit, then adding that to the savings on the 12% marginal rate on your $20,000 contribution, you earn a total instant risk-free return of 27.54%. Now I will also demonstrate the Premium Tax Credit Estimator provided by the Taxpayer Advocate of the IRS and provide more examples of how you can earn a fabulous return. To get to the Premium Tax Credit Estimator, just search for Premium Tax Credit Calculator or Estimator, then click on the link. This is the home page of the Premium Tax Credit Estimator. Notice that there are several sections at the top. The introduction shows how the credit and estimator work. You can get additional information by clicking on the gold-colored plus signs. The definition of key terms are displayed on the right side. Note the warning at the bottom that the estimator provides only an estimate and not the actual result. You also have additional links for resources. To illustrate how much you can increase your premium tax credit, I will use one of the real-life examples provided by this website. Specifically, example 2. A family living in Massachusetts had a household with 2 children in college. However, I am going to change the monthly income to show how much this credit can change with small changes in AGI, if your income is just above 400% of the federal poverty level for your household. Now we'll go to the estimator. Click OK. The tax year is already set to 2021, so we'll continue. Click Next. This is where you provide most of the information. If you need help on any specific entry, just hover your mouse over the question mark. I put in the information based on the example, changing only the current income and the monthly advance payments. Click Next. This page is only for changes that were made during the course of a year. Since this is just an example, there won't be any changes, so just click Next. And this shows that this yields a credit of $0 because it is slightly greater than 400% of the federal poverty line. Now we will go back and lower AGI by just a little bit, $50 per month. Notice that the premium tax credit is now $15,840. So by contributing a mere $600 to your traditional IRA, you could increase your premium tax credit by $15,840. A pretty nice return on your investment, not even counting the tax savings from your retirement contribution. As you can see, if this was your tax situation, by contributing a mere $600 to your traditional IRA, you lower your AGI just enough to increase your premium tax credit from $0 to $15,840. And since you're in the 22% tax bracket, you save an additional $132 in the contribution itself, yielding a total tax savings of $15,972, a whopping instant guaranteed risk-free return of 2,662%. Now note that the exact numbers will depend on your geographic location, since the cost of health insurance differs throughout the country, and of course your own tax situation. But this video shows what the possibilities are. Now granted, this fabulous return only works if your income only slightly exceeds the limits and you only make a small contribution. But even if your income exceeds the limits by a large margin, you can still earn a great return. So if your tax situation was the same as in our example, but your income exceeded the limit by $20,000, then you could contribute $20,050 to your 401k, or to a combination of your 401k and your traditional IRA, or even to a health savings account, and you would still earn a guaranteed instant risk-free return of 101%. How else can you achieve this? Now let's make this example even more extreme. Let's assume that your income is $119,450, well above 400% of the federal poverty level for your household. But by contributing $26,000 to your 401k, $7,000 to your traditional IRA, plus $50 to your health savings account, you can reduce your AGI back to $86,400, which qualifies you for that premium tax credit of $15,840. Even though this return is not as good as in the previous examples, it is still 72% on your investment of $33,050. By adding the tax savings on the contributions, that is an instant, tax-free, risk-free, guaranteed return of 72%. That is still a fabulous return. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at Estimator.com for more than 850 in-depth fundamental tutorials on personal finance, investments, and economics. Check out my books on money at WilliamSpalding.com. Thank you.